Hey, this is Eric Major with Bundle. I just wanted to share with you a couple quick tips on getting a mortgage, some common questions, and we'll review a couple examples. So, a lot of times people want to know, can I afford this house or can I afford this mortgage? And one of the things that I always try to start with is there's really three factors that will help you decide if and when you can buy a home. So the first one has to do with your income. So if you make, let's say, $60,000 per year before taxes, that's $5,000 per month. And that's sort of the starting point. So we know that even without taxes being taken out, your income is $5,000 per month. So you're not going to be able to afford a home that has a $5,000 mortgage payment, because then you wouldn't have any money left over for groceries or entertainment or anything like that. So the starting point is your salary. And what banks really like to see is your debt to income ratio. So take that $5,000 and sort of divide it by 3, and you get to roughly where you should be in terms of a mortgage payment. So that's right, somewhere a little bit north of $1,500 per month if you make $5,000 per month. So, but that is not just for your mortgage, that's also for your car payments or your student loans or any other loan payment that you'll make. Now, you can go more aggressive than that. So that was about 30% is what we were going with there. You can go all the way up to a little bit more than 50% of your income in certain loan products. So if you make $5,000 per month, then you can make all your loan payments equal $2,500, maybe up to $2,700 per month. So that really depends on your risk tolerance, how much you like to save every month, how much you like to spend every month on things that aren't your mortgage payment or your car payment. And so that becomes a personal decision. So there's sort of two questions of what can you get approved for, what's the maximum amount that you can get approved for, and then what are you comfortable spending every month. And so that's a core thing to think about. So what I'm looking at now is a mortgage calculator. And so if you see that pretty house down the road that you want to think about buying and it costs $750,000, then the monthly payment on that is this number right here, this $4,700. So if you're in that category where you make $5,000 a month, we already know that you're not going to be able to afford this every month, much less be approved by a bank to get that mortgage. One thing to think about too is this is our mortgage calculator. I work with a company called Bundle, but there's other mortgage calculators out there. They're all the same. They're all the same math going behind it. So this is just Google. So if you type in mortgage calculator to Google, then you get a monthly payment here as well. And so they're basing this off of a 30-year mortgage, just like we were. So that's the first thing. The second thing is, okay, let's say that you do make an amount of money to sort of get you into this $320,000 mortgage. Then what's your credit score look like? And so a credit score is a number typically between 400 and 850, and anything above 750 is absolutely excellent. 680-ish to 750 also very good. You shouldn't have a problem on your credit score getting a mortgage. And we go down all the way to a 580 credit score. Now when you get that, you start getting on the lower end of the spectrum. There's some other things that banks are going to look at and factor into when you're buying your home. So maybe that debt to income ratio is a little bit lower when you're down that low. So instead of using a third of your or a half of your monthly income towards loan payments, maybe it's closer to a third or a quarter. So $1,250 in total if you make $5,000 per month. And so that 580 number is lower in the market. A lot of people require you to have something north of 620 and even 680 depending on what your down payment is and some other factors that play into approval odds. Then some people can go as low as 500. That's not as common and usually requires to have a much higher down payment than a 580 credit score or a 620 credit score. So we've covered income, we've covered your credit score, and the last piece is the cash that you need to close on the first day. So the monthly mortgage payment piece of it and your income is sort of a question of, can you even afford this mortgage payment every month? The credit score question is more of a question of, hey, you've had loans in the past. How have you done paying back those loans? Have you had a good track record of paying back your credit card bill, paying back previous mortgage maybe, or student loans, or your car payment? And so that sort of measures how well you do when it comes to paying back your loans. Now the cash to close is really comes into two components. There's a down payment component. So if a bank is going to lend you, let's say $300,000, they're not going to lend you the full value of the home. You have to put a little bit of skin in the game. There are some programs that allow 0% down. Veterans Affairs has a program. If you've served in the military, you can put down 0%. Now you still have to pay some closing costs up front. So that's the other piece, is the closing costs. So this is a lot of different things that are added up to another number, and this can be a couple $1,000s by itself. Of if you think about, there's an appraisal on the property, they send somebody out there to see if the home's really worth what you're paying for it. There is a attorney's fee, so you're going to go to an attorney's office, sign all your paperwork. That usually can run in close to $1,000 maybe. There's title insurance, so making sure that the home that you're purchasing, there's no history of it being owned by somebody who has a claim on it down the road. That's a little bit more complicated, but that's money that you have to spend up front. In terms of a dollar down payment, the down payment that you have to pay towards the purchase price. So if it's a $300,000 home, a good number to start with is maybe 20%. You may have heard that number before. So on a $300,000 home, that's $60,000. So that's a lot of money for a lot of people. And there are programs where you don't need to put that much down. Once you put down less than 20%, you start paying a little bit higher interest. It's in another line item. It's called mortgage insurance, but it's an amount that you're paying every month that's on top of your interest rate. A good way to think about it is interest or extra interest. And that sort of gives the bank a little bit more comfort in lending you money to a higher amount with a lower down payment. So on a $300,000 home, you can put down as little as 3% sometimes. So that's $9,000. $9,000 down payment sounds a lot better than a $60,000 down payment for a lot of people. And once you do that, then you can pay a little bit extra on your monthly payment in the form of mortgage insurance. So that might be $100 extra per month or something like that you're paying. It just goes to that mortgage insurance that helps offset some of that risk to the bank of having a lower down payment. And so those are the three big things. So I'm going to review them with you really quickly. The first one is the fact that you just need to have a monthly payment that you're comfortable with based off the amount of money you have coming in the door every month. That's number one, your monthly sort of mortgage payment to income ratio. Number two is your credit score. So something above 580 you really are starting to get into the market. Above 620, the door opens a little wider, and above 700, the door is pretty much wide open. Now, the last piece is the cash to close. So that's the amount you have to bring day one. So this comes out of your savings, and that amount is can be as low as 3%. Like I said before, sometimes that's 0% in terms of the down payment, the amount of the purchase price that you have to pay up front. And the last piece of that is the closing costs. So $300,000 mortgage, if you have a 700 credit score and you make $6,000 a month, $7,000 a month, you're starting to get really comfortable. And you're also have, let's call it $10,000 for a down payment and another $3,000 to $4,000 for closing costs. So that those are completely rough estimates, but that starts getting you in the ball game of something north of 620. You've got a good income and you've saved up, call it $10,000 to $15,000 to $20,000. That's a ballpark, and it's just something that I like to walk through with people. And so we'll do a couple more of these videos to go over some basics, but this is a good starting point for you when you're looking for your home.